Hello students, welcome to the lecture on policies and bills, and after this lecture we will be able to learn the following objectives. Understand ECGC policy, define the ECGC covers, explain the small exporters policy, discuss the marine insurance policy, describe the bill of lading. Let's start with a brief introduction. International market involves various types of trade documents that need to be produced while making transaction. Each trade documents is differ from other and present the various aspects of the trade like description, quality, number, transportation, medium, indemnity, inception, and so on. So it becomes important for the importers and exporters to make sure that their documents support the guidelines as per international trade transaction. A small mistake could prove costly for any of the parties. Let us first know about ECG policy. Export Credit Guarantee Corporation of India Limited was established in the year 1957 by the Government of India to strengthen the export promotion drive by covering the risk of exporting on credit. Being essentially an export promotion organization, it functions under the administrative control of the Ministry of Commerce and Industry, Department of Commerce and Government of India. It is managed by a board of directors comprising representatives of the Government, Reserve Bank of India, banking and insurance and exporting community.
Hello and welcome. Joining me is N. Shankar, Chairman cum Managing Director of ECGC. Mr. Shankar, thank you so much for joining us. Good news on the rupee front. The rupee has been steady now, in fact appreciated quite a bit. So, what's the outlook for Indian exports this year?
Yeah, I would say that in the current year, that is 2013-14, Indian exports are set to grow. In the last Board of Trade meeting, which was held by under the auspices of the Commerce and Industries Minister, exporters were forthcoming and they were saying that this year they will even exceed the target of $325 billion fixed for the current year. This is mainly due to two reasons. One is that US is looking up, export orders are increasing, especially in the textile sector and all, exports are growing. Plus again in Europe also, compared to in the last one quarter, the growth has been positive. So the exports are set to grow in this year. Of course, rupee depreciated, very much earlier, but it has come up. I think now it will stabilize this level, and then it will be good for those exporters where there is not so much of import content. As you know, if there is a import content high, then the value addition to that extent only they will get the benefit. But where the import content is not very high, like you see, look at the handicrafts or like brass wares and all, there it will be a pure profit for the Indian exporter. That is a rupee depreciation is good news for such sectors.
Okay, ECGC, you were telling me, has also is also pushing awareness about Indian exports in several countries. Can you tell us about the efforts?
Actually, ECGC now, ECGC has got a branch in each of the export sectors in India, especially wherever you have got the export clusters in India. We have a branch there, and we are trying to offer two types of covers. One cover is to the Indian exporters, where we take the risk on the overseas buyers, and where if the buyer defaults or he becomes insolvent or he repudiates the claim, then we settle the claim to them. We have to encourage a flow of credit to the Indian exporters. We give covers to the Indian banks. If the exporter defaults or he becomes insolvent, then we settle the claims to the Indian banks, so that Indian banks are allowed to lend more and more to the Indian exporter. We have not raised our insurance premium in the last 10 years. It's almost constant. So that enables, actually, because we are a development oriented institution. We are 100% owned by Government of India. So we are not making the premium as a huge cost to the Indian exporters. So
since you're talking about export clusters, what are the typical problems that you find Indian export based clusters facing, and what can be done to sort of overcome it?
Because they may be having one non-financial problems, another is non-financial problems. Non-financial problems I leave it to the others to deal with, because I am basically a financial sector person. In financial sector, the credit only, like normally if you see the credit availability to the Indian exporter, the problem is that the commercial banks, if you have to set up offices in rural areas and all, it involves huge administrative cost. So naturally the cost of credit which is given to the Indian exporters will also go up. That is why we have to find a way of giving low cost credit to the Indian exporters, especially in the clusters. That is the major problem. That's why there should be some sort of a group approach, where this cost of credit has to come down.
Yeah, it's interesting that you mentioned finance because particularly working capital, a lot of export-based SMEs and MSMEs who are in industrial clusters find it very difficult to actually get that kind of finance. So what is how is ECGC perhaps helping exporters overcome this?
For this only I was just quoting in my session. There is Dr. Raghuram Rajan, he had given a report in 2008, financial sector reform. There he had given one recommendation which has not yet been implemented. That recommendation is securitization of trade receivables of the not only for exporter, for the SMEs, like that the buyer who is a buyer that is securitized, the receivables from the large buyers or securitized, converted into a dematerialized instrument which should be rated and traded, then this type of cost of credit will naturally go down. So this we have to see, now whether this can be implemented. This is one of the suggestions, because even in factoring you find that we were trying to support factoring, but the cost is high and the default rates is also high. You don't get the import factors who are ready to cover our policies. So this one idea, I hope something will happen. In fact,
it's interesting that you spoke about ratings as well, because the Planning Commission has been saying that 2014 onwards industrial clusters should be rated. How do you see that impacting the availability of finance for?
Naturally then banks will be in a better position to choose the credit, because the track record has to be good. Then they can lend. Normally the fear is that a person who defaults may spoil one rotten egg, spoil the whole basket. That is how it happens. So the cost of credit is higher for other people also. So the basic problem is the rating will enable you to remove the low rated from the high rated. Then you'll be able to reduce the cost to the better performance.
What does ECGC do? Provides a range of credit risk insurance covers to exporters against loss in export of goods and services. Offers guarantees to banks and financial institutions to enable exporters to obtain better facilities from them, provides overseas investment insurance to Indian companies investing in joint ventures abroad in the form of equity or loan. How does ECGC help exporters? Offers insurance protection to exporters against payment risk, provides guidance in export-related activities, makes available information on different countries, with its own credit ratings, makes it easy to obtain export finance from banks or a financial institution, assists exporters in recovering bad debts, provides information on creditworthiness of overseas buyers. ECGC covers. The ECGC was set up by the Government of India in 1957 to provide cost-effective credit insurance covers to exporters and banks and to promote export from the country. It functions under the administrative control of the Ministry of Commerce. It has evolved different credit insurance covers to suit the requirements of Indian exporter and commercial banks from time to time. The corporation offers covers for short-term as well as medium and long-term exports, which may involve export of capital goods on deferred payment terms, execution of turnkey projects, construction work contracts and/or rendering of services related thereto. Contract policy. Specific contract policy can be obtained by exporters that have secured contract for turnkey projects, EPC contract or any other contract which involves supplies of capital goods and services for erection and commissioning of the project. The cover provides protection against non-receipt of payments due to commercial and/or political risk. Risk covered: commercial, insolvency of buyer, protracted default of buyer, buyer's failure to accept goods. Political: war, civil war, revolution in buyer's country, new import restriction, transfer delays. LC opening bank risk, insolvency, default. Loss coverage is 90%. Obligation: obtain indicative premium rate at bid stage. Seek post-awarded approval from ADWG onward of contract. Obtain in principle approval. Seek cover after payment of premium. Advise progress of project in accordance with PEM guidelines. Declaration of overdue payments. Filing of claim within 12 months from due date. Sharing of recovery. Shipments policy. Specific shipments policy can be obtained by exporters that have secured contract for supply of capital goods such as machinery or equipment on deferred terms of payment. The cover provides protection against non-receipt of payments due to commercial and or political risk. Risk covered commercial, insolvency of buyer, protected default of buyer, buyer's failure to accept goods. Political, war, civil war, revolution in buyer's country, new import restriction, transfer delays. Obligation, obtain indicative premium rate at bid stage, seek post-awarded approval from. AD or WG on award of contract, obtain in principle approval, seek cover after payment of premium, advise progress of project in accordance with PEM guidelines, declaration of overdue payment, filling of claim within 12 months from due date, sharing of recovery. Services policy. Specific services. Policy covers contracts under which only services are to be provided. The cover offers protection to the Indian exporters against payment risk involved in rendering services to the foreign buyers. A wide range of services like technical or professional, hiring or leasing can be covered under these policies. Risk covered commercial, insolvency of buyer, protracted default of buyer. Political, war, civil war, revolution in buyer's country, transfer delays, LC, opening bank risk, insolvency, default, loss coverage 90%. Obligation, obtain indicative premium rate at bid stage, seek post-awarded approval from AD or WG on award of contract, obtain in principle approval, seek cover after payment of premium. Construction works policy. Construction works policy is designed to provide cover to an Indian contractor who executes a civil construction job abroad. The cover provides protection against non-receipt of payment due to commercial and or political risk. Risk covered, commercial, insolvency of buyer, protected default. Political, war, civil war, revolutions in buyer's country, transfer delays. Now let us explore about small exporters policy. The small exporter policy is basically the standard policy incorporating certain improvement in terms of cover in order to encourage small exporters to obtain and operate the policy. It is issued to exporters whose anticipated export turnover for the period of 1 year does not exceed INR 50 lakhs. Insurance cover for buyer's credit and line of credit. Buyer's credit is a credit extended by a bank in India to an overseas buyer, enabling the buyer to pay for machinery and equipment that he may be importing from India for a specific project. A line of credit is a credit extended by a bank in India to an overseas bank, institution or government for the purpose of facilitating import of a variety of listed goods from India into the overseas countries. A number of importers in the overseas country may be importing the goods under one line of credit. Political risks covered under the scheme are the occurrence of war between the country of the overseas party and India, the occurrence of war, hostilities, civil war, revolution, rebellion, insurrection or other disturbances in the country of overseas party, the operation of law or of an order, decree, or regulation having the force of law which in circumstances outside the control of the lender and or the overseas party prevents, restricts or controls the transfer of the sums due to the lender by the overseas party under the financial agreement. Let us discuss about marine insurance policy. A contract of marine insurance is an agreement whereby the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against transit losses, that is to say losses incidental to transit. A contract of marine insurance may by its express terms or by usage of trade be extended so as to protect the insured against losses on inland waters or any land risk which may be incidental to any sea voyage. In simple words, the marine insurance includes cargo insurance, which provides insurance cover in respect of loss of or damage to goods during transit by rail, road, sea or air. This cargo insurance concerns the following: export and import shipments by ocean-going vessels of all types, coastal shipments by steamers, sailing vessels, mechanized boats, etc., shipments by inland vessels or country craft, consignments by rail, road or air sent by post. Hull insurance, which is concerned with the insurance of ships, hull machinery, etc. This is a highly technical subject and is not dealt in this module. Types of marine insurance and marine insurance policies. The types of marine insurance available for the benefit of a client are many, and all of them are feasible in their own way. Depending on the nature and scope of a client's business, he can opt for the best marine insurance plan and enjoy the advantage of having marine insurance. The different types of marine insurance can be elaborated as cargo insurance. Cargo insurance caters specifically to the cargo of the ship and also pertains to the belongings of a ship voyager. Hull insurance. Hull insurance mainly caters to the torso and hull of the vessel along with all the articles and pieces of furniture in the ship. This type of marine insurance is mainly taken out by the owner of the ship in order to avoid any loss to the ship in case of any mishaps occurring. Liability insurance. Liability insurance is that type of marine insurance where compensation is sought to be provided to any liability occurring on account of a ship crashing or colliding and on account of any other induced attacks. Fleet insurance. Fleet insurance offers and provides protection to merchant vessels. Corporations withstand a chance of losing money in the form of freight in case the cargo is lost due to the ship meeting with an accident. Marine insurance is an area which involves a lot of thought, straightforward and complex dealings in order to achieve the common ground of payment and receiving. But as much as complex the field is, it is nonetheless interesting and intriguing because it caters to a lot of people and offers a wide range of services and policies to facilitate easy and uncomplicated business transaction. Therefore, in the interest of the clients and the insurance providers, it is beneficial and relevant to have the right kind of marine insurance. It resolves problems not just in the short run, but also in the long run as well.
How can you have peace of mind when shipping your merchandise abroad? 2 words: cargo insurance. Cargo insurance is very important because no matter what happens during the transportation stage, your investment will always be secured. If you read the small print on a bill of lading, you will soon realize that carrier's liability is very minimal. Depending on the mode of transportation that you're using, cargo liability will vary. For ocean shipments, cargo liability is $500 per shipping unit, which in many cases is considered your full container. By air, cargo liability is $9.07 per pound. And by ground, cargo liability is $2 per pound within the Canadian and US territories. If you're shipping to Mexico, cargo liability does not apply within the Mexican territory. A few points to consider. Regardless of the amount payable to you by the carrier, it first needs to be proven that the loss or the damage of cargo happened as a direct consequence of the carrier's negligence. Second, if this is proven, the question you need to ask yourself is, does the amount cover my total investment? And third, cargo liability only applies for the time or the period of time when the goods were under the carrier's control and not door to door. If we consider these facts, it is easy to determine that relying on the carrier's liability might not be a good idea after all.
Let us now discuss about the bill of loading. A bill of loading is a contract of carriage between an exporter and a service provider, such as an airline, steamship line, freight forwarder, or shipping company. It identifies the parties to the transaction and their responsibility for payment of transportation and other accessorial fees such as transfer and delivery. International Airway Bill. The Airway Bill is a contract for carriage bill of lading for shipments made by air freight. The Airway Bill is normally issued by a freight forwarder acting as an agent for the airline who transports the goods, or an air freight consolidator who may use the airline to transport the goods of several companies under its own master bill of lading. The airline Airway Bill is known as the Master Airway Bill, or MAU. International Ocean Bill of Lading. The Ocean Bill of Lading is a contract for carriage or bill of lading for shipments made by ocean freight. The Ocean Bill of Lading is normally issued by a freight forwarder acting as the agent for the ocean carrier who transport the goods, or by an ocean freight consolidator who will use the ocean carrier to transport the goods of several companies under its own master bill of lading. Differences between airway bills and ocean bills of lading. The primary difference between the airway bills and ocean bills of lading, other than the obvious, is that ocean bills of lading can be made negotiable and airway bills cannot. Negotiable bills of lading are a common practice in international trade designed to protect the seller by allowing them to consign the document to their order instead of the consignee or buyer. An airway bill is non-negotiable and is mostly consigned directly to the consignee. It is not negotiable or transferable because of the rather limited transit time. There is no time to transfer the title between parties in the limited amount of time it takes for the goods to arrive. Combined transport document. Combined transport document is also known as multi-modal transport document and is used when goods are transported using more than one mode of transportation. In the case of multimodal transport document, the contract of carriage is meant for a combined transport from the place of shipping to the place of delivery. It also evidences receipt of goods, but it does not evidence on board shipment. The liability of the combined transport operator starts from the place of shipments and ends at the place of delivery. Bill of exchange. A bill of exchange is a special type of written document under which an exporter asks importer a certain amount of money in the future, and the importer also agrees to pay the importer that amount of money on or before the future date. This document has special importance in wholesale trade where large amount of money involved. Bank realization certificate. Once the export proceeds are realized, the exporter has to prepare bank certificate of export and realization for the purpose of claiming import licenses. To prepare this certificate, the date of realization is most essential as the exporters have to apply for the import replenishment license within 6 months following the month or quarter of the realization month. Insurance certificate. Also known as insurance policy, it certifies that goods transported have been insured under an open policy and is not actionable with little details about the risk covered. It is necessary that the date on which the insurance becomes effective is same or earlier than the date of issuance of the transport documents. Consular invoice. A consular invoice details the contents of a shipment and affirms that it does not contain any illegal or questioned items. It is prepared by a consular officer working in the important country's consulate in the nation of origin. The document is written in the language used by the importing country to ensure that customs officials can read and understand it, and includes a seal confirming that it is official. Such documents may be required for some imports and can be recommended in other cases. Custom officials use this document to determine appropriate tariffs, duties, and other fees in association with a shipment. Multiple copies of a consular invoice are produced when the document is generated. One should be attached to the shipment along with any other documentation. Exporters also usually keep at least one copy for their files as a personal reference to use in connection with billing and other activities. Commercial invoice. A commercial invoice is a document typically used in the transport of cargo or shipments between one or more countries. This type of document often indicates what is being transported, the value of the products being transported, from where they are being transported and to where they are going, as well as the names of businesses and parties involved with the transportation. It will also usually indicate any fees or dues necessary or paid in accordance with tariff laws regulating transportation of goods between the two countries. A commercial invoice does not necessarily have a set format, though the above information is usually needed and other information may also be required. Proforma invoice. Proforma invoices are prepared by the exporter and may be needed by the importer for quotation purposes, to draw up a letter of credit, or to apply for the foreign exchange to pay for the goods. This applies to markets with exchange controls, particularly in Africa and South America. The invoice is sent in advance of the goods but does not differ from a standard commercial invoice. Certified invoice. Some countries require certified invoices, particularly when goods are being shipped against letter of credit. These are invoices which are certified by a chamber of commerce before goods are dispatched. Exporters present the invoice to the IEA or a chamber of commerce and they then stamp the document. Legalized invoice. Occasionally, customs in the Middle East require invoices to be both certified and legalized. After certification, invoices have to be presented to the embassy of the destination country for legalization. This involves presentation of the certified invoices to the embassy, who then attach their stamp to the document. Bill of entry. A bill of entry is a formal declaration describing goods that are being imported or exported. This document is examined by custom officials to confirm that the contents of a shipment conform to the law and to determine which taxes, tariffs and restriction may apply to the shipment. It must be prepared by the importer or exporter, with many companies hiring a clerk specifically to handle the preparation process. Now in the end, let us summarize what we have learned in this lecture. Export Credit Guarantee Corporation of India Limited was established in the year 1957 by the Government of India to strengthen the export promotion drive by covering the risk of exporting on credit. Export credit insurance is designed to protect exporters from the consequences of the payment risk, both political and commercial, and to enable them to expand their overseas business without fear of loss. The Small Exporters Policy is basically the standard policy, incorporating certain improvement in terms of cover in order to encourage small exporters to obtain and operate the policy. Combined transport document is also known as multi-modal transport document and is used when goods are transported using more than one mode of transportation. International market involves various types of trade documents that need to be produced while making transaction.